One of the things you've seen over the last couple of years is a divergence. Car sales are down about 30%, and truck sales are up about 10%. Truck sales sell for $11,000 more than a car. GM and Ford are much stronger in trucks than they are in cars.
All right, so if we take a look at the way that GM is shaping up, this has not been a favored stock among investors. None of the auto stocks have been. Can we now say that there is perhaps an all-clear signal to get back in this, or is it still a pain trade ahead given the consumer outlook?
Yeah, there's no question you need to be in the stocks. I think the market is discounting that the cycle in North America is going to be down. And for example, most people have U.S. sales down 5% or more in 2019. Since 1980, there have only been 7 times where the industry sales were down 5% or more. And each one of those cases, except for one, there was an outside factor, like the collapse that we saw in the financial community. In an environment where the unemployment rate is low, confidence is high, interest rates at an all-time low, and income growing, you're not going to have lower car sales. You might be down 1%. That's because the industry is not, goosing them up with incentives. I think you're probably going to see industry sales at 17 million units each of the next 2 or 3 years. And to me, that's what the market is missing. That will enable companies like General Motors and Ford and the suppliers and dealers to generate record profitability.
But Michael, are you actually more optimistic on General Motors thanks to this earnings report? Because, the stock is surging today, but we're just back at September levels effectively. And back in July, the company took down full year guidance, and it's only raising the top end of the guidance. And so where do we actually stand? The market's acting like this isn't all clear, but I'm not sure what precisely you'd point to say, this stock is a better stock today than it was a few months ago.
Right. And I think, well, first of all, in the guidance, they know as much as we do in a lot of respects. And so you're throwing a dart into the wind. They also reiterated that the guidance for this year would be at or above what they're looking at, and it could be well above what people are currently looking at. As far as GM today versus the summer, I think one of the things I don't pay too much attention on one quarter, particularly one that's not year-end, that's not audited. However, if you listen to a couple of things GM said, they are very clearly a different company today than they were 3, 4, 5, and 10 years ago. Just as an example, one of the things they talked about was cap spending coming down over the next couple of years. They talked about GM Financial being a source of income as much as $1.5 billion in the year 2020. GM, from a capital standpoint, from a balance sheet standpoint, go back to 2008. GM had a legacy liability, U.S. pension and underfunded pension status of $20 billion. One of the surprise things you'll see at year end is, I think, because of a higher discount rate, you will see GM's underfunded plan in the U.S. essentially be funded or close to it. Insignificant. Very different company today. And I think those are the things that I took away from the quarter, that GM, despite going through a changeover of their most important vehicle, they still made 10% pre-tax margins in North America. 10 years ago, they would have lost money.
Mike, just a few moments left here. Electric vehicles. Who ends up winning that race 5 years from now?
Well, if you look at electric vehicles, there's a little bit of a miscommunication. Electrified vehicles include hybrids. That is where you're going to see the most growth, because they can be in trucks, they can be in cars, they can be in every size of vehicle. Fully electric vehicles is still going to be a pretty small portion of the market, 1-2% at most in the next 5 to 10 years.